Good morning, Walt here with the Schultz team at Canopy Mortgage. I hope that you're doing well. Hope that you're enjoying this weekly market update. There's a lot that's going on, and I really just want to make sure that you're front and center, that you know what's going on, and that you're able to share it with those that you serve. And we're also sending this out to my clients as well, and so I hope that you guys are enjoying it as well. Well, last week was an interesting week. We ended up on Friday with a couple of the Fed presidents really talking about inflation and proving that they really don't know what's going on. Let me just be honest. They really don't have a clue as to what's going on. Several of the Fed presidents. Now, remember that there's one Fed president, that's Mr. Powell. And so underneath him, there's 12 other Fed presidents. And those Fed presidents are throughout the US, in New York, Philadelphia, Chicago, and such. And they all get together as a committee, and then they talk about monetary policy. They talk about what to do with the Fed funds rate. They talk about inflation. Remember, their whole goal, really the reason why they were created, was to be able to kill inflation. They need to make sure that the US dollar is worth as much as it possibly can be. And the way that they do that is by killing inflation. So as inflation increases, then it takes money out of mortgage-backed securities, which then increases interest rates as well. So it's just an overall bad thing. Now, we had some news last week, and we had the CPI report that came out last week. And when you take food and energy out of the CPI report, then it showed that really inflation is on its way down. And that's a great sign. That's an absolute great sign. Well, a couple of the Fed presidents had said, we still have to hike rates. Well, remember that what the Fed does takes about 12 months, 6 to 12 months to enact in the economy. So if they keep hiking the Fed funds rate, it's going to continue to slow the economy down. There's already signs that the economy has been slowing due to the CPI report, and then the next day on Thursday, it was the PPI report that came out, the producer price index. Both of those show that the economy is slowing. So anyway, we'll see what happens. It looks like it's around a 75, 78% chance that the Fed will hike the Fed funds rate again coming up here in May. We hope that's not the case. We hope that they pause. But, you know, if they do, they do. I mean, yeah, we're living in their world. The other thing that I wanted to bring to your attention here today was, let me share my screen here on this, was credit card balances. Credit card balances, again, the Fed is split as to whether there's going to be a recession, a light landing, or what's going on. I firmly believe that we're in a recession now. However, I'm not an economist. So the Fed believes that, again, I'm not sure if they're in a recession or not, if we're in a recession or not. Well, here's, again, another indicator that indeed a recession, we're either in one or it's coming, and that is credit card balances. You can see that personal savings rate, we did really well. And then when we hit the pandemic, we saved a lot of money real quick. That was due to a lot of the stimulus plans. And then we kept that savings for a little while. We spent some of it, but now personal savings is down below 5%, the lowest that it's been pre-pandemic levels. So we're down below 3%. And that's partly because of, again, the inflationary pressures and the fact that it's costing a family $500 more a month to live right now. The other thing that we see is that, and this was a recession that we had here. We had a little light recession at the very start of the pandemic. We can see that credit card balances increased. When we hit the pandemic, then they decreased again because of the stimulus plans. People paid their debt down. And people, of course, couldn't go out and use a lot of their credit cards. And of course, then, boom, we then shot up. Starting here in really February, we went from around the average interest rate on a credit card was around 14% to now an average interest rate on a credit card is 20 plus. So interest rates have been consistently increasing on credit cards, again, due to the Fed raising the Fed funds rate. And we've been using our credit cards more and more due to inflationary pressures and due to the cost of living. So those have been really looking at what's going on in the economy, what's going on with the Fed funds rate, and really watching what rates are doing with that. Rates did get better last week, and as they got better, then when the Fed decided to change what they were saying towards the end of the week with inflation, rates ended up selling off. Mortgage-backed securities sold off on Friday, making interest rates worse on Friday, and got rid of all the gains that we had throughout the week. So last week, again, we had the CPI report showed inflation is really in check. We had unemployment claims tend to be a little bit higher. The Fed, again, expects a mild recession later this year, or possibly even not an inflation not a recession this year. When we looked at unemployment claims, let me back up. First off, we also received last week the latest numbers on the small business optimism, which was from the NFIB, and it showed really that small business optimism is the lowest that it's been in a long time. In fact, hiring is down to March of 2020 levels. So really, small businesses are just deciding not to hire, which is a concern, of course. In fact, they say that the small business owners are cynical about the future economic conditions. Hiring plans fell to their lowest levels since May of 2020, but strong consumer spending has kept Main Street alive and supports strong labor demand. Let me just hit upon this here real quick. So this morning we had builder confidence that came out, and it was okay, but it was not as good as what they were hoping for. We're still below the number 50, which anytime we're over the number 50 with the builder confidence levels, then we have a tendency to, it shows that the builders are more confident. We're around 46, 47. The other thing that we had this morning, which shows really retail sales, was the New York and Philadelphia manufacturing data report that came out. And that report, again, was not as favorable, showing that retail sales are down as well. So right now we're down in the day around 25 basis points, trying to fight our way back up from the losses that we had last week. So as we go through, March's housing starts and building permits will be reported on Tuesday, while existing home sales data follows on Thursday. Those could be two market movers. We then get more retail sale manufacturing data, which again shows retail sales coming out on Thursday. And of course, the latest jobless claims will be reported on Thursday. If you haven't heard about our 101 program, we brought that back to market last week. It's an awesome loan program. Would love to chat with you about it. It's 101% financing. It's a 4%, or it's a 97% first mortgage, a 4% second mortgage, equaling a total of 101%. The seller or the buyer can pay their own closing costs. They'll have around 2% in closing costs or so, or we can ask the seller to do that. And if there's multiple offers, we can tick up the interest rate a little bit, and then we can pay those closing costs. So really, this loan has the ability to get to the point to where literally a buyer walks in with $1,000 of their own money, which in this market really cash is king, and being able to keep as much of your cash as possible so you don't get into debt really would help out massively. So I hope that that this finds you well. Again, If you have any questions, if we can help in any way, we'd love to serve you and serve your clients. Hope you have a great day and a great week. Bye-bye.